Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
All right, folks, you're on the Property Couch for each week. Ben and I bring you the insider's guide to property finance and money management. Hello, Ben.
G'day, mate. How are we?
Very good, thank you. Hey, we've got a very special guest today. In fact, we thought it was so important that we would actually jump on a plane and go up and speak to our very special guest, which we did in the shadows of the election victory. So, but before we get to that, Ben, we've got a few little things that we want to
let's get into it, Bryce.
Talk about today. Number one is footy tips, and we'll try and be as brief as possible for those people who don't like the footy tips banter. Mark with a C. No, you didn't win. Mate, you're still behind me. Mark with a C was the winner with 9.
Well, perfect. And margin, close?
Margin wasn't as good as last week.
Doesn't matter. Still that.
36,
well done.
36.
Congratulations. That is acing it all right. Very good.
And just for the benefit of the community, changed the bloody competition name, actually changed their name and mentioned that to Ivor. So we have that wonderfully. And then we've got this little comment that's come up on Facebook from Samantha Goosen. Great show with insightful information. I don't mind the sports banter either.
Oh!
So there we go, thumbs up.
There we go, thumbs up for the
sports banter. You can see all of our listeners going, no! All those who hate the sports banter. They're going, no, why did she say that?
We got a 3-star ranking or 2-star ranking because too much banter. What did he say? If I wanted a sports program, I'd go. We do read them, everyone. We do read them.
Yes. So that might bring a wave of 1-stars.
Anyone who gives us a review, thank you.
Thank you.
Yeah, even if it's a 1-star, thank you.
Yeah.
Move on, go and listen to something else if we're not good enough for you.
Yeah.
We appreciate it either way.
And just a little thing, Ben, Escape from the City last week.
Yeah, what a great show.
You said you were going to watch it.
What a great show.
Did you watch it?
No, sorry.
Yeah.
I'll watch it on iView. I'll catch up.
The listeners, Ivor, get to see the heart of this man. He's when we hit the record. Sure, Bryce, I'll watch it. Then in the shadows of no record button, what does he do? Nothing.
Sorry.
Doesn't watch it.
I had intentions of watching it.
Yeah,
but I did have something on that evening.
Our other business partner watched it. Popey loved it.
Oh, good. Popey's always good for a good watch.
He did, Ivor. He liked it. So thanks for those people who watched it. And pick up, Ben.
Yes, just our work here is not done, Bryce. Mm-hmm. So we had a great response in the lead up to the federal election, and obviously we were very active in that time. But please don't think that our job here is done. We've had success, obviously, in terms of getting the message out there that the policy was poor policy. We're not done yet. So now we're looking after policies around the tenancy acts and the reforms that are going on.
Important.
Very important for all property investors. Plus, don't forget the banks. They're not going to get off lightly, either in terms of charging us additional interest. But we need to get to size people. The more people that donate us their $5 and get educated from that donation as well, the bigger we get, the more influence we have. The more influence we have, we can go to the banks and say, hey, us 2.3 million property investors out there aren't really happy about the fact that you treat us differently in terms of when we lend money on residential property. So we're going after them. We still haven't finished at the federal level either, Bryce. I'm warming up here. You can see I'm warming up.
Slam that door shut, Ben.
Right,
come on.
There we go. Travel.
Yeah.
They completely ban any expenses to go and inspect your $500,000 or $1 million property elsewhere. I think that's unfair. I think they should have I'm saying there were excessives. We agree with that.
There's people who rewarded it.
So what about a $500 cap to go and have a look at your property interstate and $250 intrastate? So that's our policy position for Picker in regards to that. And the same with depreciation, Bryce. We think that the blanket ban on depreciation was also excessive. So we want to talk to the new Minister of Housing that's just been announced. So we've got a few people to talk to in Canberra. We'll also go and speak to our friends in the Labor Party and also
Do you have friends in the Labor Party?
Probably not, but we will go and have a conversation with them around what their intentions are, because once they know the true data, once they interact with the industry, they'll probably see the error of their ways, and we can help them with that.
So I've got an idea here, Ben, because $5 seems ridiculously cheap, and
Yes, it is.
there's a very large representative
Or $20 for 5 years.
who haven't jumped on board yet.
Yep.
So it'd be interesting to know if there's any barriers that people have before joining. So we might put a little thing up on Facebook, Ibis, and give Ben some feedback. Let him know what is it that needs, or what would it be need to tip extra people over the edge to get that membership up, because you know that once you've got a bigger community, Ben, you've got a bigger voice, and you can better advocate and defend for those people.
And I'll tell you, Bryce, as soon as you become a member, that $5, you get the recording of the webinar where Tim Lawless effectively gave an hour of his time to give us the latest update on the market. Now that in itself, people pay big money to go and hear Tim speak. So you would get access to that in the membership area of the website. So
value.
as long as there's other things going in there, so we've got checklists in terms of, so if you're speaking to a property manager, you can ask what questions would you ask a property manager to find the best property. All of those things are now being built in to the members area on the site. So your $5 is really great value for all the extras you get. Thank you for giving me that opportunity to talk about Picker.
So we'll just put that up. So let us know if there's any barriers, folks, so that Ben can learn what he needs to do to overcome them. And if you're thinking that you're on the fence and you want to join Picker and help Ben with that momentum, that wave, to have a voice in Canberra.
Yeah, and if you're not investing yet, but you're going to be a future investor, you can join as well. Anyone over the age of 18 can join the Non-For-Profit Association.
Very good. Hey, my Mindset Minute theme today is very, very simply a encouraging thing, Ben. Don't take criticism from someone you wouldn't take advice from. So that's for you to think and ponder, because quite often we are taking advice on the downside from people that we wouldn't take advice on the upside from. So yes, I was clicking through my Mindset Minute.
Sorry about that, everyone.
Well,
if you've got your headphones on and just you click.
Well, if I only knew the irony of how over 234 episodes, how many times have I been bollocked for clicking my pen?
You're tapping your pen or something like that.
So that was nice. Well picked up, Ben. So folks, don't take criticism from someone you wouldn't take advice from. I found that from Jim Quick. I thought it was very, very good. Too quick to take criticism on the down, Ben. But if you wouldn't take the advice on the up, don't take it on the way down.
Thanks for that, Jim.
Hey, today, Ben, we, just to let our listeners know, we recorded this last week.
Yes.
We jumped up on a plane, we went up to Sydney, the three of us, because we wanted to talk to this man, well and truly in the shadows of the election, because his commentary, his observations were quoted quite a bit.
Yeah, the forecast that he put out there based on the impact of the changes through negative gearing and capital gains tax. Yes, it was.
Throughout the campaign. So let's cut to our interview with Louie Christopher. All right, Ben, so we've got a very special guest today. We're chatting with Louie Christopher. Louie is recognised as one of Australia's most respected and impartial research property analysts. He has extensive knowledge and experience of property and is regularly quoted in the media on his insights, and is a director of SQM Research. Welcome to the Property Couch, Louie.
Good to be here.
Thanks for coming on. Hey, listen, you're obviously the director of a really large research house, which is you're probably most prominently known for in the media now. But take us back to the beginning. How did you get involved in this area, and how did you get involved in property in particular?
Oh, well, I guess the beginning goes all the way back to probably when I was about 5 or 6 years old, because my grandparents who raised me, I'm actually an orphan, they raised me. My grandfather was an accountant by trade, but he liked property, he liked shares. And so I had an exposure, an early exposure at that age to the property market through some of the properties he owned. That experience was actually bad because my grandfather would try and personally manage the properties, and he ended up having a whole bunch of bad tenants, and I would always see the end result of that, which was like paint on the walls and all these terrible things. And then of course he had an interest in the share market, so he would take me down to the stock market when it was an open cry system, the Sydney Stock Exchange. And I was very fascinated
Watching
by all
the
this
chalkies and
yelling and the chalkies. It's like there was definitely a buzz to it. And so from an early age, I had just a passion or an interest in investing and understanding. It started there, and then, as mentioned, with property, it was always a mixed experience. I recall when my grandfather died, and a couple of investment properties went over to my grandmother. She was ripped off. on a property she tried to sell. She was ripped off because she didn't have enough information. And that really struck me because we didn't actually have a lot of wealth at all. It's just a couple of investment properties.
Yep.
And she was doing it tough trying to raise this young kid in her last years of life. And I think that was probably just the trigger, I guess. It's like, we need more information in property. We got to stop people getting ripped off. This shouldn't be happening. And yeah, that was probably just a bit of a seed in my mind from that point onwards.
So you studied commerce through
university? Yes,
Yep.
I did a bachelor's degree in accounting with the Griffith University of Queensland. There was also a sub-major in economics.
Yep.
So that was my first degree, and then I did a postgraduate diploma back here in Sydney with what was known then as the Securities Institute of Australia.
Yep. Yep.
Yeah.
And the pivot back into the property space. Tell us about the job career journey.
Well, it was personal at first. So in my third year of uni, I was becoming quite interested in terms of the opportunity in property, and I was in Queensland at the time, and I started looking at actually commercial property to begin with.
What year were we talking here?
This was 1995, and I found this industrial property for sale on the Gold Coast, actually on Brisbane Road, Labrador, if you know the address.
I do.
It was selling on a net yield of 12%, and I thought that's a pretty good yield.
Yeah.
And I knew, and basically at the time you could borrow the money at around 8%. The only thing was I had to convince a bank to lend a university student, $500,000. Of course, I got many, many no's on that, but I had one yes. And I brought a plan to them in terms of how the numbers could work. They believed it. I had a little bit of capital I could give them, but it wasn't that much at all, I can assure you of that. But I went for it. So I bought this industrial property. It was about 1,000 square metres. It was basically just sheds.
Yep.
And it was quite an experience. Put it that way, at the end of owning that property, I didn't have any hair left. And I was only about 27 at the time.
So to put that in context, back at that same period of time, you could buy a townhouse in neighbouring Southport for under 100,000, closer to 70,000, right?
Yep.
So that's like, so what was it like having all those zeros as a debt? You said it
was stressful. That's what it was.
And because of the sheds, that was where the difficulty in terms of managing the people.
Yeah, I had to manage. These guys were like, they'd been around the block, and they saw this young, 22-year-old turn up saying, I'm your new landlord. Yeah, they must have rubbed their hands. In fact, they did, because no sooner had I bought the place, two of the tenants stopped paying their rent immediately. Right. And since I had a monthly service back to the bank, I was immediately under pressure straight off the bat. So it was an ugly experience to begin with. But in the end, it helped me toughen up. So with these tenants, I tried to play straight back with them in terms of getting them to pay their rent on time, and that wasn't working. So in the end, I locked them out one day. So I just put locks on the sheds, which was a scary moment to do because I didn't know how that could actually respond. And we're talking about, Gold Coast guys that have been around the block. They took it the right way, actually. Started paying around on time, so I got away with that one. Not that I would recommend doing that. So
how did that phone call go? When the first time that you
a lot of swearing. A lot of swearing. But I think they realised then at that point I wasn't going to be messed around with, and they should pay their rent on time.
Yep.
So that was fun. But that was one of my first direct experiences, certainly with commercial property. But once again, through that whole experience, I realised that there was lacking information, and I could have probably done better or made better decisions through all that, through having better information. In the end, we did okay out of that property. I certainly didn't get wealthy on that property. I sold it off effectively around 5 years later, made a smallish profit. The important thing is I got through it.
Did you realise the net cash flow that you sort of saw?
I was getting it towards the end. I was achieving it, and in hindsight, I should have held on. I really should have held on, because what happened was that capitalisation rates compressed right throughout the early 2000s in a big way. And I did get some capitalisation rate compression, but I could have got a lot more if I held on. That was the other lesson, is that with real estate, you've got to hold on. It's really hard to flip property in this country because of the holding costs and the transaction costs. So yeah, that was a good lesson. But yeah, the information side was a really good lesson for me. At the same time, professionally, I started off once I completed my degree in a grunt job working with MLC back here in Sydney. So that was just a job just reporting in to investors, unit prices. Whenever the market would do something crazy, they'd put me on the phone to explain to investors that their funds are okay and explain the reasons, the gyrations in the market. So it was recognised even back then that I had a little bit of a natural ability to explain market conditions, which I think is probably one of the reasons for our success today, is that we're good at explaining and providing some understanding in terms of why things move the way they do in the markets. So yeah, from that point onwards, I guess the break in terms of being recognised in property wider than my just own personal experience came in 2000 when I took a job with Australian Property Monitors, as it was known then.
APM.
APM. Yep. That was a fantastic experience. Immediately I saw opportunities with the data they had. So back then there was actually no national data provider. CoreLogic, back then known as RP Data, was just focused on Queensland. APM was focused just on New South Wales. And the various institutes really were dominating the data space in many respects in terms of providing indexes. So looking at this data that was coming through, straight away the first thing I thought was, we can create more indexes out of this to tell the market what's actually going on. So we got to work on that, and we started providing some pretty interesting indexes out there in the market, one of which is still published by the Reserve Bank today, which is the APM, now known as the Domain Stratified Housing Price Index. But that whole experience was, I guess, that's when I started getting a bit of a profile. We started writing notes about what the market's doing, and there seemed to be a lot of interest in those notes. The auction clearance rates, of course, I was at the time in charge of ensuring that we were correctly reporting on the market each weekend. And I took that part of the role very, very seriously, to the point where I'll never forget, in 2004, we had a major run-in with the REIV, who were trying to get into having their auction results reported in the Age. And we were playing a very conservative line in terms of the auction clearance rate being reported in Melbourne. We would have a situation where if agents were refusing to report results to us, we'd send people their way to get the auctions regardless, and they really hated that. So
Data is power.
Yeah, but unfortunately we lost that battle regarding the REIV. The Age, I think at the time, felt a lot of pressure advertising-wise. So in the end, they went with the REIV.
Because when did APM get bought by the Domain?
2006.
Yep, okay.
That happened in 2006. I was made general manager. I was head of research prior to that point in time, and then on that acquisition, they made me general manager. And the run-ins regarding the reporting of auction clearance rates actually came to a head shortly afterwards. And at the time too, I really started feeling like I wanted to run my own business regarding real estate information. At the same time, I was made a job offer by a research house called Van Eyck Research to basically cover the managed fund space in terms of doing ratings on that side. I took that role on the proviso that I told the proprietor at the time, a respected fellow by the name of Stephen Van Eyck, that one of these days I'm going to go out on my own and I'm actually going to start SQing research here on the side, if you don't mind. He was okay with that. That was the play, but yeah, leaving APM it got a bit ugly because I wrote a rather large note to all our subscribers that I thought the auction clearance rates being reported in the Age weren't quite right. And a lot of people took exception to it, and I explained why they weren't quite right. It got nasty.
So you were reporting both New South Wales or Sydney and Melbourne, right? They're the only two auction markets that really matter. I mean, there's just not enough transactional data, and statistical reliability on the other markets to even warrant serious discussion about how they're impacting the market. But what other data were you really desperate to get your hands on that you thought could give you a better insight? You know, it's very clear in your backstory there that information is power, and so was there any sort of Nirvana of data back in those days? Because you've got to remember, some of that time it was pre-internet when you were first starting out, and then we saw the internet come in and collecting that data. Was there any data that you would have really have loved to have had back then that you can easily obtain today?
No, I think in terms of the data itself, we had it all back then. We were just getting it on a more manual way.
Yeah.
So APM had all the licenses with each state's valuer general, and we literally had a large team of people monitoring all the real estate listings out of the newspapers. And you can imagine the effort that went into and the costs involved in doing that, right? And then there was another team of people each weekend, which was about 30 people ringing up the real estate agents to get the auction results.
Yeah.
So it was a mammoth exercise. What changed was basically the ability to monitor ads online and the movement away from print to online advertising.
Yeah.
And I'll never forget it. It happened about 2005, where we realised there were ads which were only being advertised online only and not in print anymore. That was a point where it started crossing over, where you'd see these ads that are only online, not in print. It's like, wow, okay, interesting.
Yeah.
So we started then monitoring websites.
Yep.
Well, the ugly word, of course, is called scraping.
Yeah.
And I've never apologised for it because we're not. It's not as though we're competing with the real estate listers. We're not.
Yeah.
We're a research firm and we're aggregating the data. And yes, SQM Research monitors websites today.
Yeah.
And we've had our run-ins with some of the major listers, but they've backed off for some years now. They realise we're not competing with them.
Yeah.
So they basically know what we're doing.
So, Louie, what does SQM stand for, and what were the early days? Clearly, SQM's a successful business now, but what was it like in the early days?
That's right. The early days. Well, as mentioned, at the very beginning in 2006, that's when SQM was registered. And by the way, SQM stands what's the abbreviation for square metre. So, and I literally just came up with one. I didn't hire anyone to come up with a special name. I just thought, oh, that'll do. Yeah. And I think more to the point is, I know a business is all about being authentic and providing a genuine service. If you can do that, you can call yourself anything. It really doesn't matter. That's my view anyway. I could be wrong. But
well, I remember the first, having someone who's also, makes decisions based on data.
Yeah.
When we first discovered, I remember first discovering the site, the very first site when you had done some work with API and you were releasing your yields.
Oh, yes,
and your vacancy rates.
Yeah.
Yeah, that was some of the very first data that you pushed out there. And I was all over it. I'm thinking, how good's this?
Well, we're still the only research house that provides a rental vacancy rate for every postcode in the country.
Yeah.
Domain's now trying to do something, but they don't have the back series. And CoreLogic still have left it alone, which I'm quite surprised. I guess they've looked at it as being, they're too big and doing something that's just really nichey. But for us, that's helped a lot in terms of being first to market with that particular index.
Yeah.
And it's quoted widely today. You do a Google search and we come up first when you put in vacancy rates. And so that's worked well. And I guess this just goes to the heart of the information and trying to provide something which is unique and different, hasn't been done before.
Yep.
And certainly back in 2006, 2007, that had not been done before at all. And now today, of course, we've got various indexes on the website, and right now we're doing a major site revamp, and there'll be more released.
Oh, watch this space! This space.
We'll have some details in the show notes so people go and check that out as well. But so if we do reverse back, you left some comfortable jobs. You wanted to start.
That's right.
SQM.
So SQM was on.
Was it just you at the beginning?
Just me. So we just did it. I just did it on the side while I was doing a full-time job doing investment research on managed funds with Van Eyck Research. Then in 2010, I actually bought out that investment research piece on investment funds and put it all, basically did a management buyout. and put it all under SQM research.
Yep.
You know, that's the point where SQM became more than just property data. And if you come to our website today, you'll see we've got a section on shares, we've got a section on managed funds, and of course a section on property data as well. But yeah, the big jump to going out on my own in 2010 was scary. But I think the experience of my younger years, where I bought that first commercial property at uni and going through all that stress, helped me a lot in terms of making that jump from a comfortable executive job to going out there on my own. We have had scary days, and I'm sure you guys will know, growing a business, it's certainly far from easy, especially if you're competing with larger groups who've got the scale. That can be interesting.
So what was the drive? Because you mentioned twice that as a 5-year-old
Yeah.
and as a mid-20s, that
Yeah.
was that always the burning vision that you still wanted to? You knew what you wanted. You knew there was a better opportunity to get insights, and you felt that you could fill that void that no one else was. Because
I did.
When you face those darker days, right?
Yeah.
It's got to be something that's still pulling you along.
Well, it's interest and passion. Look, I started life behind the 8 ball. Like I said, I was an orphan. I lost, I didn't have a father, and I lost my mother when I was 5. And I think through that, and then I lost my grandparents when I was 21. So I was out on my own completely from that age. And I think that forced me to be very self-reliant. I guess it forced me to survive. And, I'm a strong believer in taking self-responsibility. But I'm also a believer in taking a bit of a gambit from time to time, not being a gambler per se, but making calculated risks, but being prepared if you are going to do a big leap in terms of, say for example, leaving a full-time job to go out there on your own show, you've got to be prepared. You've got to do the hours and the homework to ensure it is successful. And there's been times where, we've run it pretty tight. But you get through those days, and if you've got something which is unique and is of interest out there, you should do okay.
So you're obviously quoted for your insights in the media, but what is SQM known for in the marketplace to your clients? Where's the niche that you like to be positioned?
Tell you like it is, I guess. I mean, we don't always get it right. If we're doing forecasting, and a little bit of our business is forecasting. Not everyone gets the future right, but I think more often than not we've been able to get it right. And I think through having that really informative data helps in picking the turning points in the marketplace. And one thing about property that I know is that it is a bit of a momentum-orientated market that rarely chops and changes over a short period of time. Once a trend has changed, it'll stay in that new trend for quite some time. And I think that's helped somewhat in terms of being able to better forecast. The other thing too with property versus say shares is that there's risk-free opportunities as well if you know where to look in property. Harder to find it though in shares, though definitely we're a believer in diversified investing, and on the shares front I've always had a personal belief that you shouldn't day trade stocks. You should look at the stock market as that you're investing in a business, a quality business long term. That's easier said than done, of course, especially if a stock's moving, say, 5 or 10% against you in a day. It can be very difficult. But I've got some personal rules in terms of how I go about my share investing, but it's having very much a long-term view and strategy on high-quality businesses.
So it's obviously a busy week. You're pulling in hundreds and thousands, if not millions, of data points every day.
Oh, we do, yeah.
Yeah, and then collating those into, I'm assuming, a data lake, sort of some type of layout there.
It's
putting all together.
We're always working on trying to improve our databases. So
Yeah.
I'm sure you're well aware property data in itself can be raw, can have lots of errors in it. So we've got a lot of rules. We have people working on those databases to continually improve them.
Yeah.
I still see improvements to be made in property data. So for example, those of you out there familiar with property data will be well aware that on the unit data front, it's actually very hard to get unit sizes, like square meters for say an individual unit. You can get say bedroom numbers, but the valuer general is not really reporting on unit sizes
Yeah.
in terms of square metres. So
Yeah.
we're looking to try and fill that gap as much as we can. That's a work in progress. So. One of the things that I've loved that we've done recently, it's probably getting a bit on now, is that if you go to our website, we've actually mapped out for every locality the price per square metre relationship between land size and price. And the thing is that that relationship, of course, is that the smaller the land size, the higher the price per square metre. But not many people are aware that the relationship isn't linear. It's kind of exponential. So that price per square metre rockets up the smaller the land size. Mm-hmm. And so we've actually mapped it out for every locality. And so the reason why you would look at that is potentially that there is a risk-free profit in certain areas over others where if you subdivide or you develop it, you've got a better chance of making a profit than potentially other areas.
Yeah, that's great. And obviously, we're a big believer in land to asset ratio in terms of the mix of what you're buying and getting that spread right, which I think is a great segue in terms of, you were mentioning before, when you're seeing those data and the trend is your friend.
Yeah.
What are some of the top data signals you're looking for in what particular area? I mean, it's pretty clear that auction clearance rates are good indicator of short-term demand.
That's right. They're good. They're good on the aggregated level for Sydney and Melbourne.
Yeah.
Keeping in mind there can still be issues in the reporting. The biggest issue has been of late the level of unreported results.
Yeah.
I usually tweet out each weekend what the clearance rate is and what we think it really is, taking into account the unreporteds.
Yeah.
There's issues there, but the auction clearance rate still has been quite a reliable indicator in terms of picking turning points in the marketplace.
Yep.
And it has helped me in terms of our forecasting. So I regularly look at the auction clearance rate. I like to look at our overall listings data, which once again we have that up for free in terms of mapping every area, stock on market we call it.
Yep.
I always take a close look at that. I also like to look at days on market as well, which you can read from the same information.
Yep.
And then we look at other wider sort of indicators that are often published by the ABS. So, for example, housing finance approvals, building approvals. These are all sort of fairly leading indicators. Of course, we have our own asking prices index. So what vendors are actually doing. Are they lifting their prices or are they reducing their prices? And at the moment of late, they've been naturally reducing their prices. There's a whole bunch of indicators I like to look at, both leading and lagging, and then of course some of the fundamental indicators, which may not necessarily pinpoint a turning point in the market, but potentially could tell you that, look, a turning point is due.
And so what are some of those? Do you take a look at the average household income? Do you look at economic activity per city for our major population centres, or do you drill that down SA4, or what sort of?
Generally, our forecasting that we tend to do is at the capital city level. So we naturally provide data at the locality level, but it's very difficult for us to do forecasting at the locality level. That said, though, we have a quantitative rating score which we use at the locality level, which automatically takes into account some of these leading and lagging indicators. But the qualitative research we do on the housing market, I generally like to stick with the capital city level and what's happening at the macro level. On that front, in terms of working out fair valuation, I like to always compare nominal GDP versus dwelling prices and have a look at those two relationships there. And I have found a relationship there in the past that certainly can explain the movements, particularly in Sydney and to a lesser extent Melbourne and some other cities as well.
So in a very basic term for the listeners, that's basically saying you're reading the stretch in affordability against the valuation of the assets in that location.
That is correct. We generally take a fundamental view when we've looked at all the data and that we think that there are some cities which, even despite the correction we've had, remain overvalued. And ideally you would want to see the market, say, stagnated for some time or a further correction to bring it back to fair value, and that is particularly the case in Sydney and Melbourne.
And are you overlaying that with a percentage of household income on a debt of an 80, like an affordability range as well. Like CBA has theirs set at an 80% loan to value ratio against average weekly earnings as an example, gross average weekly
Definitely earnings we take into account the level of debt that's out there and the serviceability required to look after that debt. But it's also other factors such as employment growth. We look at population growth. I mean, Sydney, for example, historically has been fairly expensive for quite some time. It varies in magnitude in terms of that expensiveness.
Yeah.
We've come out in the past and we said perhaps Sydney and perhaps Melbourne as well should be considered like, say, a blue chip stock on a stock market which trades, the best companies trade at a very high P multiple.
Yeah.
Of course, there comes a time where even the best stocks trade at a too high PE multiple, right?
Yep.
So
themselves. Yep.
And that's where Sydney and Melbourne stood effectively in late 2016 and into early 2017. And while that overvaluation wasn't in itself the trigger for the downturn, what it meant was that the triggers required to create a downturn were less.
Yeah.
And so in the end, all it triggered it was just this simple move by APRA to restrict interest-only lending. And that was the final domino for the markets.
It was a late hammers there. I mean, as soon as you saw 54% of new funding, going to investors as opposed to traditional long-term, that being around sort of 35%, you just knew that the market had got ahead of itself.
That is correct. It's an interesting argument and debating point you find, especially with the housing bears that are out there. They like to look at the debt levels and say, we've got a big problem in this country. Look, to be fair, I think fundamentally, you would want to see debt levels less if you could.
Yep.
I think where they go wrong, more often than not, is that there's still always ammo by the Reserve Bank of Australia and other bodies to use to get the market going here. And they always underestimate that. They always think this has got to be it. This is the big one that's going to create the big 40% plunge. But as we're about to find out, the powers that be have a lot of influence on the market. And rightly or wrongly, having that debt in the system can be used in other means in terms of lower interest rates, loosening lending credit. The bears will say, of course, we'll get to eventually to a point where there's no more ammo to be used. They may well be right. We're certainly not there yet, though.
No, and I think one of the interesting things about residential as an asset is we've always said that the owner-occupier is the market maker and the investor should be the market taker.
Yeah.
And they buy with their hearts, not necessarily their heads. It's
that's
like a bit
true.
of fine art.
But there's also a counter-argument which I tend to side on that. Look, you do not want to have an economy that's overly reliant on housing.
Don't disagree with that at all.
In an ideal world, that those debt to GDP levels should be coming down. And I think now with the most recent statements from APRA, from the Reserve Bank, it's likely they're going to expand again. I am a believer now we're very close to the bottom in the market, even though we're bottoming out for Sydney and Melbourne in particular at a bit of an overvaluation point. The last downturn, which ended in 2012, we got back to fair value in Sydney. We got back to fair value in Melbourne. And that created the conditions for the next lift upwards that we had from effectively early 2013 all the way through to 2017.
So what's your measure of fair value, Louie? What are you back to a debt service ratio?
I always look at that. Income levels, nominal GDP versus house prices is my favourite measurement. And I found a relationship there.
You've got some, in terms of when you're looking at it, it's all synthesised data, right, isn't it? We're measuring it against median value, we're measuring average income, so it's never going to be an exact science, is it?
It's not an exact science. I mean, this is our arbitrary measure that we use, that we've found a strong relationship with. It should not be the sole measurement. There should be a range of measures one should consider. And so we do look at a range of measures, of course. Leading and lagging. And I've always taken the view that, okay, rightly or wrongly, the market may well be overvalued, but if the leading indicators and the powers that be want to see an uplift, they can get it. And if the leading indicators suggest, the market's going up, the market's going up, even if it is overvalued.
Yeah. Whether they're trying for stabilisation to get consumer confidence and consumption back up, probably is the argument at the moment.
I think that's probably where they're coming from.
Yeah.
I'm very sure that's what Scott Morrison wants.
Mm-hmm.
It's what the Reserve Bank of Australia wants, because their inflation numbers are well below where they want it. The overall wages growth in this country is very benign indeed.
Yep.
I think though we need to also consider, why is that happening? Why have we got very low income growth happening? Why have we got very low inflation in this country? And it's not just our country, it's actually a bit of a global phenomenon.
So do you have a view on that?
Yeah, I do, and I think it does go back to probably excessive debt levels. The fact that, okay, if you have a scenario where there is excessive debt levels, everybody is servicing that debt, and it means that their disposable income is lower to spend on, say, housing, to spend on goods and services.
Including businesses, per se, in terms of raising
That's right.
wages. Yep.
So it's hard then to create a bit of an inflationary environment where a lot of the disposable income is going to servicing debt.
Yeah. And how much of the technology age and the digital age is also playing there? I mean, I read a fantastic paper from Governor Lowe last year on the democratisation eventually, that filtered down. But right now, we in terms of AI and machine learning and some of these tools.
All these are productivity improvements. And,
correct.
You may recall there was a point in time in our economy where people wanted to see lower inflation, and we didn't have enough productivity. Well, we certainly got it in spades now, right? So, productivity improvements have definitely helped in terms of keeping inflation down and, of course, wages growth down as well. But there's still the opportunity to create that demand pull effect where we get demand going. We can lift the inflation if that's what we want to do. But it's just probably a little bit more trickier these days to pull it off correctly. And I think overall the economy is becoming more and more difficult to manage.
Yep.
So Louie, you we're obviously in the shadows of an unexpected coalition victory, and your opinion was sought throughout both the 16 and 19 campaigns. What was your observations of the negative gearing policy? And did it change from 16 to 19? And now that we're on the other side of it, what do you think that impact will have on the property market?
It didn't change from later 16 to 19. Earlier 16, we were quoted, and I noted that the Labor Party tried to bring this up as much as possible.
They did.
That we had a different view, and we did state that we had a different view. Two things changed our view. From certainly earlier 2016 to later 2016. Firstly, when we made that view, I was more or less theorising based on what the rental market was doing. When we took a closer view of it, we realised a couple of things. When we looked back at that time between 85 to 87, we realised that rents, yes, were skyrocketing in nominal terms, but they were actually pulling inflation up. A number of the bears out there will state that, okay, that period 85 to 87, the rents went not much further up compared to inflation at the time. But the truth is, in our view, that rents were pulling inflation up because rents were a very large component of the CPI back then. It still is now, quite a large component. And when you look at the data, our view was that rents were really starting to accelerate, which then fed into the inflation number. The truth is, of course, is that nominal rents in Sydney were over that period. I don't have the exact numbers with me right now, but it was well over 20%. It was getting up to the 30s, if I recall.
Well, I did the data as well, Louie, in terms of and pushed it out just before the election on 3-bedroom houses.
It was up 43.
Yeah,
I remember, and that's a massive increase.
Massive, well above inflation.
If you look at the breakup of that CPI at the time, not only were rents basically one of the larger components of the CPI, rents over all the other goods and services were rising at a lot quicker rate. Mm-hmm. And that's why we concluded, hang on here, rents are pulling up CPI, which is a really dangerous situation. And I think potentially Keating realised this. He would have had some advice that potentially this was going on, but arguably this is the reason why he changed his mind on negative gearing.
There's no other reason why you would change it.
Yeah.
Like, I mean, you also quoted the construction outcome of that as well. Do you want to
That's
share?
right.
Yeah.
So when we look at the construction levels, at that time construction fell by over 20% over the period. It was pretty clear to us that investors were not interested in picking up new properties at the time. And that was also feeding through and fueling inflation. Because if you're not building enough to support underlying demand for real estate and the population was growing, that's going to put upward pressure on prices.
And the bear commentators were trying to argue that was a booming stock market. And so that's why all of that money was being...
That's rubbish.
So, yep.
And the thing is, you'll find too that when you look at, like, I know ABC did a fact check, which I think was authored by Sol Eastlake.
Agreed.
If you look at that piece that Sol wrote, he left out the construction argument.
Yep.
He left it out.
Yep.
He left out the piece about, hang on, what was really going on with CPI at the time. Barely a conversation about the fact that yields were rising as well at the time.
He was very quiet in the last couple of weeks leading up to the election.
He was quiet.
And I think because he was also quoted with the data that we detected, which was that only 7% buy new when we know it's around 40 to 45% are buying new now. So that debunked their argument there too.
Now, to be fair, we've always said that, look, we take the view that potentially you can change negative gearing over time. One of the criticisms we had with Labor's policy was that we felt that they were making change far too quickly over a short space of time. And we took the view that, okay, potentially you could implement this change over a 3-year period, so phase it in. And we still take that view. And I still think that taxation should be looked at as part of a broader piece in terms of how do we improve affordability. Potentially it could include negative gearing. Potentially it could include stamp duty relief. Potentially it could include a broad-based land tax as well, right? So there are many things that we could look at here. But changing negative gearing the way that Labor wanted to do it during a time where we're having a housing downturn, which potentially has been creating downward pressure on the greater economy, don't think that it was such a smart thing to do timing-wise.
Yeah, well, I think there's a couple of things going on there too in terms of we've seen social housing and public housing completely dry up, which is a state-based obligation, not necessarily... So there's the intended and unintended consequences of such policy change. And so as the chair of the Property Investors Council of Australia, one of the things that we've said is I don't think you should change negative gearing. I think that is enough of an incentive in the earlier stages to help with supply. But the capital gains tax is one that we would say could in a booming market could bring in speculators. Now traditionally the entry cost in and the entry cost out is prohibitive, but at a 50% capital gains discount after 12 months. So we're of the view that in the first 12 months, no exemption. Year 1, 10%, year 2, 20%, year 3. So all of a sudden your flippers and the people who might be buying the door-uppers, which is where the first home buyers also want to get into that market, right? So if we're talking about making it fairer, I do see once you get back to the 5th year, which is then that they have provided that stock and as you say before, one of your observations, I wish I never sold that commercial property. If you hold property over the long term, it looks after you very well. But you also pay your fair share of land tax. You pay your fair share of positive receipts in terms of income tax, because you want that thing to be a passive income to provide your result. And then you're not on the handout welfare wheel later in retirement. I think there's a mix in there that's very difficult to try and put your finger on.
There's no perfect solution to trying to improve affordability. All I know is that it's going to take a deep dive and some hard decisions, which, we need to consider the timing of those hard decisions. We need to consider the greater ramifications. We also need to consider too that, basically housing ownership rates in this country are not that bad in the scheme of things compared to globally. We're at 62.5% in terms of home ownership rate. It used to be 70%, so there has been a deterioration. Then again, back in the late 1940s, it used to be under 50%. So it has improved. I think a sign of a strong economy where its citizens are enjoying the benefits of that economy evenly, high ownership rates. Now, how you get to that, you've got to be careful. It's hard to do it in a short sprint. Sure, you could do it potentially the way the states try to do it, where you lend out to literally everybody, but we can see how that plays out.
Yep, that's definitely going to put a bit more demand in the system, that's for sure.
So there are longer term solutions, and it's probably something I'd like to further research and investigate, I guess, but I probably ended up just doing on the sidelines and doing it there. It's hard for us as a research house to really do that professionally.
I hope that that this time around that there is consultation with industry. One of the big criticisms we had with Labor was that they went into their bean counters and and into the academic world for their information with no property experience at all. I think it's a good invitation for them to sort of say, if we're going to reconsider policies in all areas around investing and taxation, that to consult with industry rather than just telling us, here's a policy, we've done the numbers, PBO says it's great, but it's based on wrong numbers. Shockingly wrong numbers, not just a little bit out, but almost double, if not triple, in terms of the incorrect data that they're using. Now, the industry would have picked that up in 5 seconds if they had said, look, here's the data, here's the assumptions that we're going to use in doing our modelling. Don't do that because it's wrong. All right, well, what are the right numbers? Oh, okay, it's not as good as we thought it was. Next idea. Next idea. If it is, if this a nation's going to grow in terms of prosecuting best ideas, then have good consultation with subject matter experts. Would probably be a good starting point.
I would agree with that, very much so.
Louie, the last thing for me is, you came out in your newsletter during the week and you essentially suggested that you had 4 scenarios.
Yes.
And you crossed out 1, 2 and 3.
Yep.
And sort of suggested now on the backdrop of a coalition win and some of the changes at APRA and some of the possible interest rate cuts, you've sort of moved to scenario 4. What do you see happening in the next 2, 3, 4 years?
Yes, so each year we release our annual National Housing Outlook report, which we call the Housing Boom and Bust report. Normally get it out in October, November for the forthcoming year. And we normally release it with some scenarios in terms of, well, what would happen if interest rates were cut, interest rates lifted, something crazy happened in the world. For this release, we did it on the scenario, one of the scenarios was an unlikely Liberal win. And back in November 2018, it was looking very unlikely.
Very unlikely.
Nevertheless, we ran it as a scenario, and I'm certainly glad we did. And so that scenario basically assumed status quo. No changes in negative gearing, no changes in capital gains tax. That scenario basically takes the view that the housing market in Sydney and Melbourne may well bottom out later this year. It assumed that there may well be an interest rate cut, but it would happen later this year. Now, here we are, present day, and there's been 3 major developments which have happened just in the space of really the last few days. And that is, number 1, the Libs did win the election, and I take the view that the market was market participants before the election. There was a lot of uncertainty in the market by both buyers and sellers. That uncertainty is now gone. Number 2, the next development, of course, was APRA. Earlier this week, the Australian Prudential Regulation Authority, stating that they are now going to take away the theoretical servicing limit that banks should apply to all borrowers. This is basically assuming, can a borrower handle a theoretical interest rate of 7%? That is now gone. What's effectively replaced it is a theoretical rate which is 2.5 or 250 basis points above the interest rate that the borrower will have.
Now floating rather than fixed.
So if you say you've got a loan at 4%, the bank wants to know whether you'll be able to handle if that loan goes to 6.5%. So that's changed. That effectively means a loosening of some of the credit restrictions that are out there. And then, of course, the statement earlier this week by Governor Philip Lowe, that it's looking likely, or that they're having a very close look at interest rate settings for the June meeting. And I think most economists, ourselves included, take that to mean that it's very likely rates are going to get cut. So,
do you have a view on how much you think it will get cut by?
potentially they could do more than 25. If they do more than 25, it's really they want to stimulate the activity, they want to stimulate the market. 25 may well be enough. I think they need to be careful about creating a new boom out there. I don't think too many participants want that, but I think it's very likely they will do at least 50 over the course of, say, June and July, or June through to August. No matter, it seems as though rate cuts are coming sooner than what we anticipated in our report, which we assumed later in the year. So what this means, in our view, is that the bottom in the housing market's coming real soon. Certainly the 3 developments combined in short space of time, wow. I think that will increase confidence. I think with the change in the credit restrictions, basically that means that there's now going to be more qualified borrowers out there, and they will have more borrowing power. All this to us means that demand for housing is likely to rise coming from both owner-occupiers and investors who have been out of the market for some time now. Of course, we've got a fair bit of surplus stock in the market in Sydney and Melbourne, so that stock will be absorbed first. So we should start to see a fall in listings, but they're at fairly elevated levels now for both those cities. So the market shouldn't spike up, but we should, though, I think, see price rises starting to occur later this year. So a bottom happening soon, then should be enough buying pressure to start putting prices up. But sellers have got to be very careful, because if they think that tomorrow they can lift the price, I think they'll be very disappointed, because there's still a lot of stock out there that needs to be absorbed.
So I've got 2 last questions.
Yep.
I'm conscious of time. The first one is the first home owners saver scheme.
Yeah.
Deposit scheme, the guarantee. 10,000, but Josh Frydenberg saying, they'll open it up a little bit more from 1 January. So
Yes.
given all of the confidence and the return and the consistency that we're looking for in the market, plus what you've just said, do you see that having a material or an immaterial impact? The 10,000 is sort of immaterial because it's going to be spread, but if they do open it up for more buyers into the market, a little jump? Or?
Well, I see it as it's different. This initiative is different from the first time owners grant scheme by one important way. This is not a cash handout per se. Borrowers will have to pay the money back, and there's limits on it as well. As I understand it, they're suggesting the total limit's going to be $500 million. So we've worked out if it is a $500 million limit all up, that equates to effectively about 6,000 transactions. So I don't think in itself would be enough to juice up the market.
Yep.
If it was a first home owners grant scheme, where they're going to throw in $15,000, fantastic, happy days. But no, it's different. So I think it will have a different impact upon the market. I think it's only going to have a modest impact, if that.
Yeah, so if they open it up to 1 billion, which is what Josh Frydenberg is saying, if it's successful,
right?
If it's successful,
news. Interesting.
Yeah, if it's successful, he will open it up further.
Well, then that could change things a little bit.
Yeah, but not material. We shouldn't all be going out thinking we've got to rush in because there's going to be no space.
Well, the other thing to take into account as well is that it will take the cooperation of the banking sector.
Correct.
I've always looked at this initiative as like a deposit bond, and you would be well aware that the banks have not always been very happy about deposit bonds. Now this is different because it's effectively a government guarantee.
Correct.
So they should be on board. But then again, there's always been previous initiatives where the banks have not been on board despite the government involvement. Consider NRAS, the National Rental Affordability Scheme. Banks didn't really like that.
It never really took
crafted.
It was poorly crafted because the ownership wasn't defined correctly, right? So
there was a few reasons for it.
Yeah.
So this is why we need more information
Yeah.
in terms of exactly how this is going to be working coordinated with the banking sector.
Okay, very good. Last question. In your observations of being in this industry for many, many years, decades, is there a particular location? Do you have a view on blue chip and regional, out wide, closer in for capital growth? Is it trying the land scarcity closer in will always win the day?
So what areas to buy? That's what you're trying to get at.
Do you have you probably have an unfair advantage based on what you were saying before around the fact that you have risk-free spots. You've seen the correlation, and because it's the information in the property space isn't as readily available as is in the equity space, there is insider trading, and you could take advantage of that given your IP around this and your years of devotion to it.
Yes, but I'm not going to tell you the areas to buy right now.
No, I'm not asking that. I'm more asking around long-term investing.
Yes.
Not hotspotting. We don't do hotspotting on this podcast. We never have. We never will.
Good.
But in houses versus townhouses versus further out versus regional versus...
Look, I've always taken a personal view that it's not bad to have a little bit of land. Okay, so I know this has been said more often than not, but it's the land that appreciates rather than the building. The building effectively depreciates. There are exceptions to that rule, of course. Long-term inner-city dwellings, you could apply it. In fact, but the building itself may well appreciate.
That it's some intrinsic value in the building.
There's some intrinsic value in the building.
It doesn't cost you more to rebuild it now than later. Correct. It's just on paper it depreciates.
Look, I've always been a believer in investing in good, diversified economies. I think that takes a bit of the risk out of the whole thing. I've always generally taken the view you buy established over, say, brand spanking new. I think there's too much of a premium to be paid over brand spanking new. It's also one of the reasons why we're a bit critical of Labor's proposal, because they were trying to funnel investors, novice investors as well, into off-the-plan developments. I also I like to occasionally take a bit of a contrarian view. So right now I'm a little bit more favourable towards Perth. The rental market's taking off there, but the for sale market's still falling, and yields have really taken off. Now we know why the for sale market's still falling. It's been a combination of a very soft economy up until recently, higher defaults than the national average, but a couple of things have changed. Okay, firstly, remember that the WA state government's negotiated a better deal on GST receipts. That's flowing through as we speak. That's going to help a lot. And now we've got iron ore over $100 a tonne. And that's going to get things going in that state and city. Well, for how long? Good question. But the recovery, the commodities market bottomed out in 2016. So there's been a recovery since then. It hasn't yet fed through to a whole bunch of new projects for Western Australia, but I think we're getting up to that phase now because we built too much capacity in the last commodities boom of between 2010 to 2012. Arguably, that commodities boom really started back in 2002. So, we're just getting a little bit more favourable to Perth.
Okay.
Everyone should keep in mind, though, that can be a city where there's a little bit more volatility historically than, say, compared to Sydney and Melbourne.
It's interesting you say that. Perth's my hometown, right? And we've been looking under the bonnet. In fact, our team had some training with a local Perth person this week just to have a look under. But if you're investing for the long term, for me the challenge is you may well get a spike, but then will you get that consistent growth over time? Tasmania's just had a wonderful spike.
It's had
but then will it flatline for a bit, right? So
let's keep in mind that what moved in Tasmania first was the rental market. Then the for sale market came. And I think that's what's going to happen in Perth. So the rental market's already moving in Perth. Eventually, it's going to feed through to the for sale market. So I agree in long-term investing as well, trying to invest through the cycle, but I can't help myself. I like trying to look at the cycles too.
Yep. So would you, so the view, Perth to stay in for the long term or to take a slice of the action and get back out?
I think if you buy well now, you could take a long-term view on it if you wanted to. It's long term, I am bullish on that city. I think the economy will become more and more diversified. It's a little bit of a way to go yet. It is a very shallow market. When a downturn hits, it's hard to get out if you're an investor, and when the downturn hits. And certainly investors have experienced that in recent years. But long term, it is definitely a growing city. There's no question about it. There's a lot going for it long term.
It's a livable city.
Certainly is.
Louie Christopher, it's been awesome having you on. I think our listeners have benefited from your years in the field. I particularly enjoyed sort of getting to know the backstory on where it is to have you positioned here in SQM. Good luck
no problem
in the next couple of years, and I'm sure that there'll be plenty of our listeners looking to your new revamped website.
We're working hard towards it. So we'll be putting up some new indexes. We'll be making our indexes a lot easier to access as well. The site, I mean, at the moment, it's just looking old. I'm really keen to do the revamp. It's going to look a lot far more pleasant, put it that way.
Well, the message to our listeners is go and check out what it looks like now, because it won't be that for long.
It won't be like that for soon, that's right.
And hopefully we can get you on in 12 months' time or 18 months' time and get another update from you. It's been an absolute pleasure. Thank you so much for your insights. We really appreciate it.
Thanks for coming on the couch.
Thank you.
There you go, Ben. It was in fact, I really enjoyed the fact that he knows the data, he knows the numbers, he's known for crystal balling a little bit, but we actually got the backstory, so we got to know him a whole lot better and understand that square meters or SQM research is something that he's passionate about. But to see that SQM research is largely because his grandmother got ripped off in a property deal. That's where the seed was planted, I think he said, as a 6-year-old.
Yeah.
It was really interesting evolution of that story.
Yeah, and you know, behind these people who are industry leaders and thought leaders, there is a backstory, right? And we get to know the person behind those numbers, and also, you know, that commercial deal that he did up in the Gold Coast. You know, so he's been in the field, right? So he's got that. You know, we always say when we talk to research people, we want to know how much skin they've had in the game. You know, in terms of Louie's had skin in the game, and when you've got that, you've got
in the arena.
Yeah, you've been a man in the arena. You've talked about that before, Bryce. So that's what I like about him. He's actually got practical in-field experience. He's not just looking at the data and just sort of making interpretations on the data. Now, of course, that's a sample of one exercise he's done, but he's gone on to do other things, positive and negative. And as he said, what was one of his big takeaways? Shouldn't have sold when I did, you know, and I hear a lot of valuers who've got those backgrounds who are like, and real estate agents are the same. Why did I sell? Why did I sell? So there are stories there we all can take away as regular punters.
Yeah, very good. So we've wanted Louie on the program, on our show for a little while now. He's someone whose commentary is well sought after, and we wanted to make sure that our community was able to hear from him. So hopefully you enjoyed that, folks. I thought it was a terrific insight into someone who knows the property market from a statistical point of view very, very well, and as Ben said, overlay the right amount of practical as well. So, hey, my life hack today is, Ben, setting your location, your parking location manually using Google Apps. So Google Maps, sorry. Now, quite often I've kind of got into the habit of, particularly in an airport, I'll take a photo where my car is.
Right.
But if you're in a shopping centre, or if you're somewhere that you're thinking, I've walked around, where's my car? You can actually go into the Google Apps. For some people, Apple Maps, Ibis, I'm not 100% sure. What do you get? Do you use Google Maps on your phone?
Yeah, she's not going to.
Well, she can nod.
She can use Google. Come on, Ibis, do you? Yes.
Yes, she nodded.
Yes, she's nodding. That's good.
So,
it's good to have a bit of interaction from our audience of
one,
isn't it? That's hard work.
She's giving me sign language here, folks. If only you could see the daggers I was getting. But,
I'm not stupid, Bryce, is what she's sort of like indicating.
So, it's an Android, right? Yeah, but you can still get Google Maps app on an Android, can't you? Can you help her out, Ben?
Yeah, no, I can't. She's not talking.
Right,
so anyway,
let's just.
Android runs on Google.
Oh, did everyone hear that? No, don't cut that bit out. Come on.
No, we're not cutting that bit out.
So if you go to the map, please don't cut that out. That'll be fun. If you go into the map, Ben.
Yes.
And you go to the Explorer.
Google Maps. Yep.
What you do, you get the little blue dot.
Yep.
Simply click on the blue dot.
Yep.
Set as parking location. Bang.
Oh, that's clever.
Don't even worry about it, Ben. Oh,
click
Ibis, you're interested
on the blue
now.
dot.
Just click on the dot. Then when you come back,
show Ibis again. Just click on
the blue dot.
So that's the moving dot, the one that moves. Click on that, and a little
set as parking. Ibis.
Oh, that's good. I did once lose my car in a shopping centre.
Did you?
Yeah. You want to hear the backstory?
Yeah, I do now.
So everyone. So if you finish listening, turn off. We'll see you next week. So here I'm. This is when I was the sales rep for Hamilton Island.
Yeah.
You
Australian Financial Review, you up in your Hamo days, you had the big fish. We've got to talk about that as
well.
Oh,
yes. Well, no, that's another story for another day. So this story is I'm going into the Queensland Government Travel Centre they used to have in Parramatta. So this is when there was travel agents in shopping centres, going back a few years, show my age. So I arrived at sort of 5 o'clock. The centre shuts at 5:30, so I go and do my presentation, deliver the muffins and all that type of stuff. And then like everything's being shut down, and all of the gate, everything going down. I'm like, all right, I've just got to go out here, my cars, get out into the, I'm like, I've never been to Parramatta Shopping Centre before in my life, as you know, Melbourne bought. And I'm like,
where is it?
Car's not here. And in fact, I have no idea. Try and get back into the shopping centre, but everything's shutting down and the security. So an hour and 15 minutes, I am trying to work out how to get into the car park where maybe my car is.
Maybe.
But as all these other cars are going, it was getting pretty easy to spot.
That's right. The filtering was
so I have had that embarrassing moment as a 26-year-old.
That was BG.
Walking around a shopping centre going, was it here? Was it here? Does that look familiar to me? No, because it's a rabbit warren. If back in the day, Westfield at Parramatta is a massive shopping centre.
So there was life BG Ivis before Google. So Ben, if we had Google back then, you would have been able to find your car park.
Would have been able to
imagine
find.
Uni, mate. I got a university degree without using the internet. Imagine asking a student. For those who don't know Ivis, she's Gen Y, so she wouldn't understand BG.
Yes, no.
But that wouldn't happen. So all you need to do, Ben, tap the blue dot.
Love it.
Set as parking location, put it out of your mind, no decision fatigue, get on with it, do your presentation, make sure the muffins are delivered, Ben.
Beautiful.
And then that's what you need to do. Did you know?
Did you know, Bryce? I thought I'd just take a moment and talk about some of the things that we've been talking about over the years to sort of reflect on how well we've been tipping some of these outcomes.
Okay.
So, I didn't tip the election result. How would I know, right?
Let's set this up. Let's get the framing right. Did you tip the football team that won last year?
Yes. Yeah, I did. So I made sure, even though my football team was in the grand final.
You went on national television and said Collingwood was going to win the day of the grand final.
No, I didn't. I said they were going to lose. And that's why Ali came back at me and said, you don't even support your own team.
All right, fair enough.
So I did
played.
pick that it was going to be a close game, but I thought I know.
I tipped the margin after the siren, so I was only a minute 40 out. So,
well, if what's his name had marked that ball, it would have been a bigger margin, right? I can't even think of his name. I've rubbed that memory from my mind. But let's go back and we talked about winter was coming, so we said that the property market was going to overcook itself, which it did, and we said it was going to correct. Right, that's what we said.
It corrected back to the point that we predicted it.
Yeah, 2016.
And then when it overran.
Pretty much, right. So we've also been talking about how this has been a macro-prudential government interference in the market that has corrected it.
Handbrake.
They put the handbrake on the market, and we said they've done their job, right? Now, from there, at the middle of last year, if you listen to a few of my commentaries around the interest rates, I said I thought interest rates were going to come down in the event that the economy was going to slow on the back of the property market. Things like wealth effect, those types of things. So all big stuff, right? So we've tipped. So here we are. I think next week we're going to see a rate cut.
Of how much?
25. Yeah. I don't think it'll be 50. I don't think they need to do that. And I've been calling on Wayne, is it Bears? I can never quite get his surname there, the head of APRA, who doesn't do interviews. He basically said, I've been calling on him for middle of last year again. Okay, Wayne, you've done your job here, nothing to see. If you keep going, the construction industry will fall apart. Well, construction forecasts were down 40%. So now hopefully that's going to come back in. So I've got to give credit where credit's due. Wayne's been listening. Thank you, Wayne. Very good for you to finally come to the party. To our good friends at the Reserve Bank, I think they do a stellar job. Difficult, given that we're supposedly
you think they listen
at emergency rate levels, right? But I've always said, don't underestimate the impact that residential property has on the broader property and economic climate of Australia.
It's critical.
Everything I talk about in regards to where I think things are going are based on what's going to happen around wealth effect, what's going to happen more broadly. So, with that in mind, and we also tipped ScoMo as well, being the next Prime Minister. Thank God we didn't go far right. I mean, who would have thought that's not where we want to end up? Anyway, back out of the political sphere. So, what's my next tip in this Did You Know section? My next tip is I'm calling September, maybe even August, as the bottom of the market in terms of the valuation corrections in residential property.
In the two big cities you're talking about?
No, Australia-wide. I think, Australia-wide, right? So I think it won't take much for valuations to basically start to bottom out. So bottom out in either August, September, and a little bit of growth at the second half of this year.
Yeah, well, landscape's changed. Yeah.
The landscape has changed, and we are seeing that in our business. And what people just wanted certainty.
Yes.
They wanted certainty. They got that certainty. Everyone was putting their hands in their pocket. They know that the economy. So I'm expecting a bounce. And if you think about it, $1.08 today for the iron ore. Right, $108. My bad.
I'll buy it for $1.08 if you get it for me.
Sorry, $108 per tonne. So we may even sneak into a surplus at the end of this financial year, whereas we were still expecting a deficit and then into surplus the following year. That coupled with the infrastructure spend at both federal and state levels, economy's looking better.
Puts a bit of distance away from the R word, Ben.
Well, lots of R word non-existent now, right? Just not even in play. And if you go back to when we had
recession for those people wondering what the R word is.
If we go back to when we had Turnbull in power, we were growing at 4%, and we were talking about rate rise. You know, that then you bring political uncertainty, you bring investment uncertainty, you bring business uncertainty. That flows down to consumer uncertainty, and the whole thing falls over. Right? Yep. That's how sensitive the economy can be. Now, sentiment is definitely turning. We are, as I said, we're a sample of one in our business, but I've done a ring around, and there's no doubt that there's definitely a different mindset out there. There's a couple of things we need to do in terms of if Mr. Andrews, our state Premier, if you're listening, Mr. Andrews,
he's happy to spend on everything except for where we need it.
I've been pretty critical of. I've praised you on some good policy, such as the equity share scheme. I think I really like that as a policy for people trying to get in to the property market, single parents and single people on low incomes. I think that's a brilliant policy. I think that should be looked at more widely. But I'm on you about East West Link, mate. Seriously, right? The federal government
said, here's the cash, let's get it done.
$4 billion of our money, Bryce. Our money.
Says there's no need. He has to justify it.
And he says it doesn't stack up. I mean,
what? But that makes sense though, right? Because
how can it not stack up?
It totally makes sense.
How?
Because he went into an election saying that if you vote for me, I'll make sure it doesn't happen. So he can't do it. Like, he just cannot. He cannot about face on it. Even if it was blue in the face, it makes sense.
That's the politics, right?
Well, that's what we're dealing with.
No, but he doesn't have to deal with that now. So when he won that first election, right, it was line ball, right? And so he needed those inner northern seats, and that's why he, after initially agreeing to it, don't forget, remember he said, bipartisan on this road, we need this road. Then when the bean counters came back and said...
when he could get into office.
Yep, so I get that, right? But that was the election before. He then went about doing all the railway lines. Got it. Tick. No problems there, right? He's sort of manufactured this whole, what are we calling it? The ring train line. I think that's absurd. I mean, my personal opinion, an opinion of one. But I mean, once we have autonomous cars by 2030, all of that, you can just get in a car. It'll take you anywhere, right? So, and it'll be more efficient because it knows what the other cars are doing. So, just crazy that we would spend tens of billions of dollars on a rail line. We need rail intercity and interconnectivity, just like we need an East-West Link, right? And this is what I don't like about all politicians, and that is all the time we're always reactive. We're always at a stage where we never ever plan for the future, or very rarely do we, right? Maybe Snowy is a big scheme where that's nation building and that type of thing. But this type of road infrastructure is critical to move people quickly from one side east to west, right? It makes and it can work beautifully in with his tunnel, which is more of a bridge than a tunnel in regards to freeing up the West Gate. So my point is, this is our money, Labor and Mr. Andrews. So I would want you to say, take the money. It already cost the taxpayer $1.3 billion in terms of getting nothing for that money other than paying out contracts where we didn't see any effective gain or efficient infrastructure built. So I'm going after that particular bit of infrastructure. I think it's critical.
It's absolutely critical.
So it doesn't stack up now, but when we have 8 million people in this city, they'll be going, oh, we should have built that 10 years ago. Some of the infrastructure that we're putting in now, we needed years ago.
I've lived in a part of the city up until recently that would directly benefit from not having that congestion in place, but it's an about face. People look to politicians for leadership. That's wrong. They're in there for power, not for leadership decisions. Because if they have short-term mandates, they're always going to make short-term decisions.
Serve the people. That's all we ask you to do. And this is money that is being offered to you. Green light it. It's a good policy, and you're not going to get a political backlash, because when you got that political backlash, it was 2 elections ago, right? So this time around, you're doing a good job on other projects, but this is money that we're going to have that you're not going to get for us, and it's going to not build Melbourne into one of the best cities in the world again. And our biggest problem in the city has been congestion. So, I'm standing up for what's right.
Awesome, good information there, mate. Very good information, but I'm not clear on what the did you know was. Was it the tipping or was it the infrastructure?
You're right. That wasn't my did you know. That was just my rant.
That was your own call.
Remember that thing that I was going to introduce, calling bull dust?
Yeah.
I'm calling bull dust, but I'm also calling big smiles because the economy's going to be moving ahead.
Right.
And moving ahead means jobs and means greater prosperity for everyone.
Yep, it does.
All right, so congratulations.
So what is your did you know then?
So my did you know, Bryce, is did you know
Here we go.
that the Stig and I tipped Fremantle on the weekend, Bryce?
Right. Yep, well done. They won by a point after the siren. It was a wonderful win for Fremantle. Kept them in the 8.
Who'd you tip?
Why is this important?
It's your team.
I tipped Brisbane.
Brisbane.
Yeah.
Okay, just like I tipped Sydney. And that's it for the show. See you next week, everyone.
Until next week. No, so it's an insurance play, right? It's an insurance play.
Well, it's the same with me. I mean, I saw 7 of our best players out of the team. Sorry, Collingwood. I didn't think we'd get the buddies back. I'm thinking, I'm just listening to the commentator saying it's going to be a tight contest. So I'm like,
boo-hoo,
oh,
Collingwood Destination Club. I feel really sorry for you, mate. You follow Fremantle for 25 years and then tell me, don't judge me until you've been in my shoes.
Well, I watch your
football
team and I understand exactly why
you're married to a Fremantle supporter. I do. And this
Speaking
weekend,
of which, this weekend,
we're on a plane at the same time as this game. I've already thought this through because I'm aware that.
So Jane and the boys are going.
Yeah.
So she'll be obviously going for Freo, and Jack and Harry will be going for the Mighty.
I was over at your place the other day. I was trying to recruit Jack and Harry to Fremantle, but they are rock solid.
Yeah. It took me a while to get rock solid, though.
I don't know what you've done.
Well, mate,
but they had fear in their eyes, Ben, at the thought of changing. So I don't know what's being said behind the scenes.
Cold hose out on the lawn, mate. You should try it one time.
Very good. Yeah, I'm not sure what people are right in, Ben. So
yeah, I'm only joking, of course. And Bryce, I know this is the longest sign off, and did you know ever?
Yeah.
But hey, just a quick little shout out.
Yeah.
Andrew Bogut. Tomorrow, game 1.
The Property Catcher's very own Andrew Bogut.
Yes, we've had Andrew on and I've given him my best wishes, wishing him all the best. So from all of the couches out there, good luck, Andrew, in the 7-game series.
I'll be watching all this. It's supposed to be a 4-game series.
Well, they are a very good side, old Golden State. So good luck in the NBA Finals.
He's been getting some good minutes too.
Yeah, he's definitely carrying his weight out there. There's no doubt about it. He's a great passer. Sets awesome screens and does the defensive work. So,
so the Property Couch's very own Andrew Bogut. Good luck.
we're trying to buy you, Andrew. Anyway, good luck, mate, and hope it all goes well for you and you come back with another ring.
Until next week, folks.
Knowledge is empowering, Bryce, but only if you act on it.
Well said. See you next week, folks. Hey there folks, Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarises the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.